Hey there, welcome back to my channel. It's been a little over a year since I started investing with the Magic Formula, which is a stock investing strategy that I learned from Joel Greenblatt, a legendary hedge fund manager, in his book, The Little Book That Still Beats the Market. So I figure it's time to give you an update on my portfolio. In this video, I'm going to give you a quick recap on how Magic Formula investing works. Then I'll show you my portfolio and debrief you on the action, including what I bought and sold, how the stocks performed, dividends I received over the last year, etc. Finally, I'll summarize the 4 key lessons I've learned over this past year of doing Magic Formula investing so that you can be better informed also if you ever decide to implement this strategy in your own portfolio. Now, I don't want to repeat myself too much in this video, but I do want to give you a quick recap on what the Magic Formula is and how it works. So basically, the Magic Formula is a set of stock screening criteria that is based on just 2 financial metrics. 1, earnings yield, and 2, return on capital. The idea is that stocks with high earnings yield and high return on capital are bound to do well because you're essentially buying good companies at cheap prices. Just to refresh your memory on these metrics, earnings yield compares a company's earnings to its purchase price. And the higher the earnings yield, the better, because it means you're getting more bang for your buck. And now for the other metric, return on capital compares a company's earnings relative to the capital spent to generate those earnings. So for example, if it costs the company $1 million of startup capital to set up shop and get into business, and they make a $100,000 profit that year, then that company has a return on capital of 10%. Or 100,000 divided by 1 million. And basically, the higher the return on capital, the better, because it means the company is able to generate a lot of profit on a limited amount of resources. So check out my original video right here on the Magic Formula for a more in-depth explanation of these 2 metrics and why they're so important. But basically, the logic is that by using these 2 metrics, earnings yield and return on capital, to screen out among all the stocks that you could possibly buy, you're left with a smaller pool of good quality stocks that are bound to outperform the market. So there's really nothing magical about this formula. Buying great stocks, i.e. stocks with a high return on capital, and then buying them at bargain prices, in other words, stocks with a high earnings yield, is probably the most fundamental concept of successful investing. And there are lots of studies that demonstrate that this sort of value investing approach outperforms the market. And following this kind of philosophy of buying great companies cheaply has made investors like Joel Greenblatt, Warren Buffett, Charlie Munger very, very rich. But what is special about the Magic Formula is that instead of reading through 100-page annual reports and studying company financial statements, the Magic Formula helps you find great stocks just by using 2 of these convenient financial metrics. So you're supposed to just invest like a robot based on these 2 metrics, holding anywhere from 20 to 30 Magic Formula stocks in your portfolio at any given time. And then you're supposed to sell each stock after it's been in your portfolio for 1 year, and then replace that with a new Magic Formula stock each time. I actually have yet another video, which is a detailed step-by-step tutorial on how to actually implement the Magic Formula. So check out this video if you need a tutorial. Now, in his book, The Little Book That Still Beats the Market, Joel Greenblatt compares how a Magic Formula investing strategy would have performed relative to the S&P 500 over a 21-year period, from 1988 to 2009. And it turns out the Magic Formula crushed it. It returned 23.8%, while the S&P 500 returned 9.5%, which means a $10,000 investment would have grown to $885,387 using the Magic Formula, compared to just $67,250 investing in the S&P 500. Now, I couldn't find any more recent performance data. It only goes up to 2009, but you get the idea. Now, you are probably curious, how is my portfolio doing? And the short answer is not that well. So let's have a look at what happened. I started implementing the Magic Formula at the beginning of April 2019, and I bought Magic Formula stocks in batches roughly every 2 to 3 months until I had 24 stocks in my portfolio by December 2019. Now, the instructions, according to Joel Greenblatt, say that you're supposed to hold each stock for 1 year, sell it, and replace that stock with a new Magic Formula stock. And if the stock happens to still be on the Magic Formula list, you can just keep it in your portfolio for another year. And that would be the equivalent of like selling that stock and just buying it back at the same price because it's still a Magic Formula stock. So over the course of 2019, these are all the Magic Formula stocks that I bought. And I bought about $700 worth of each stock. And that was 24 stocks for a total of a little over $16,300. And I bought my first batch of stocks at the very end of March 2019. So when March 2020 rolled around, that means 1 year is up, so it was time for me to sell that first batch. So I sold all the stocks in that first batch, except for the ones that were still on the Magic Formula list. So before you do anything, you have to first check the most recent list of Magic Formula stocks on the website, magicformulainvesting.com. So I ended up selling Acorda Therapeutics, BIIB or Biogen, PetMed Express, and Natural Health Trends Corporation. And I bought Arna, or that's our Arena Pharmaceuticals, Omnicom, Xerox, and the ones that I kept were Hewlett Packard, Mastercraft, Boat Holdings, and Weight Watchers, because they were still on the Magic Formula list, so I decided to keep them. So again, what I did was I sold all the stocks that were no longer on the list, and I bought new ones. And if I was holding any stocks that were still on a Magic Formula website, then I decided to keep them. All right, so out of the stocks that I sold, PetMed Express and Biogen were at a significant profit, about $200 each. And Acorda Therapeutics and Natural Health Trends Corporation were at a really big loss, unfortunately. And actually, Acorda Therapeutics got totally killed. I bought it at $13.15 and had to sell it at 85 cents for almost a 100% loss. So that kind of hurt. Not gonna lie, it was hard to sell these stocks at a big loss, especially knowing that with the pandemic, it was a horrible time in the market to sell anything. But hey, that's what the Magic Formula wanted me to do, so I did it. And you know what sucks? My Magic Formula portfolio was doing pretty well at the end of 2019. It was doing well for most of the time. And now in 2020, after this whole coronavirus stuff, it's in the negative. So initially, the amount of money I invested into this portfolio was $16,389.14 to be exact. And now the portfolio is worth $14,563.66, which amounts to about a minus 11% annualized return. But on the bright side, I have received $92.17 in dividends thus far, just in 2020 alone. So that does make me feel a little bit better. So it was a smooth and easy ride all through 2019 when the stock market was trending upwards and pretty much all stocks were going up. But that has not been the case in 2020. In fact, these last few months haven't been easy for anyone who owns stocks during the pandemic. If you held stocks from January to April of 2020, chances are your portfolio took a hit. I mean, at least temporarily. And a portfolio of Magic Formula stocks would be no different because every company was affected in some way. In fact, at some point in late March and early April, my Magic Formula portfolio was down over 30%. But obviously it's recovered a lot, so now it's just 11%. So that's it for my 1 year portfolio update. Now let's talk about the key takeaways for your Magic Formula portfolio. I've got 4 lessons I want you to take away from my experience. And the first lesson is that detachment is key. The more emotional you are about your investments, the worse decisions you're gonna make. And even when it feels crappy, you want to try and make rational decisions and follow the strategy or whatever formula that you are using. And in the case of Magic Formula investing, there is a clear set of rules for what to buy, what to sell, when to sell. So you want to put your emotions aside and just follow the rules as best as you can. Yes, it sucked selling Acorda Therapeutics at a huge loss, at basically 100% loss. But the Magic Formula says you dispose of stocks after 1 year unless they're still on the Magic Formula list. So then that's what I had to do. And the way the Magic Formula works is that it works on average. Not every single Magic Formula stock that you buy in your portfolio is going to work out. It works as a whole. In fact, you can pretty much expect that some Magic Formula stocks are just not going to do well because a lot of the stocks are on the Magic Formula list because they're companies facing problems or headwinds of some sort. Otherwise, they wouldn't be cheap enough to be on the Magic Formula list in the first place. So some of them are bound to go south, like Acorda Therapeutics did, while others are bound to recover. And that's what we're looking for, the ones that recover. So that's why it's important to look at your Magic Formula portfolio as a whole and not get too hung up on the performance of any one stock. There's gonna be winners and there's gonna be losers. Something else that really helps me stay detached and to just follow the Magic Formula is the fact that I'm not planning to touch this money until I'm a lot older. It's not like I'm gonna become a bag lady and be on the streets if this portfolio doesn't work out for me in the next few years. I'm gonna be just fine. I mean, it's just $16,000, so it's not gonna make or break my future. So I think this is key. I'd probably be a lot more emotional about all this if we were talking about like $100,000, because to me, at this point in my life, that's a lot of money. But $16,000, I can live without. So I can be more detached with it. So my advice to you is if you're gonna do Magic Formula investing in your own portfolio, make sure you're able to remain fairly emotionally detached to the outcome, which you can do by not investing more money than you're comfortable with and by keeping a long time horizon. That's why it helps to get started investing when you're young, because by definition, you probably don't even have a lot of money to invest to begin with. And it'll be easier to stay calm throughout the ups and downs since you won't be needing that money for a while. Lesson number 2 is to think about the market cap of the Magic Formula stocks you want to buy. If you go to the Magic Formula investing website to use their stock screener, you'll see that the first criteria you have to punch in is minimum market cap. So if you type in 50 into that field, which is the minimum you can put in there, that means the Magic Formula is only going to screen for stocks that have a minimum market cap of at least $50 million. Now, if you type in 100, you'll get stocks that have a market cap of 100 million or bigger. If you type in 1,000, because this is in the millions, that means you'll get stocks with a market cap of 1 billion or more, and so on and so forth. Stocks with a market cap of 10 billion or more are considered large cap. So these are gonna be huge household name companies like Disney, Starbucks, MasterCard, AT&T, and stocks with market cap of 300 million to 2 billion are considered small cap. And then even below that, stocks that are between 50 million or under up to 300 million are considered micro cap. In general, the small cap stocks outperform large cap stocks. However, they are also much more volatile. Here's a chart showing the performance of large cap versus small cap versus micro cap stocks over a 50-year period. So the yellow line here is the micro cap stocks, and the blue line is the large cap stocks. So as you can see, there's more money to be made investing in micro cap stocks. However, the caveat is that micro cap stocks are much more volatile. So this table shows the standard deviation of each size segment. Standard deviation is a number that tells you how large the ups and downs in your portfolio are going to be. The larger the standard deviation, the more of a roller coaster ride you can expect. So as you can see in this chart, large caps have a standard deviation of 15.26%, while micro caps have a standard deviation of 20.6%. Big difference. A standard deviation of 20.6% means huge moves in your portfolio up and down. Also, note that in its best year, large caps returned 37.45%, while micro caps returned 80.98%. Crazy! So what does this have to do with the Magic Formula? Basically, if you want higher returns, put a small number for market cap, like put 50, which is what I did, but only do it if you're gonna be okay with the volatility. Now, if you're okay with slightly less return in exchange for more stability, then put a larger market cap number in there. So if you put 50 million in there, most of the Magic Formula stocks that turn up won't be any that you recognize. But if you put like 100 billion or 10 billion in there for market cap, you'll get household names like Best Buy, CVS, eBay, Fox, household names. All right, so if you do go for the micro cap 50 million limit, just be forewarned, a Magic Formula portfolio already sees a lot of volatility. So if you have micro cap Magic Formula stocks, that's gonna be even more volatility. Based on historical data, in times of market stress, a portfolio of micro cap stocks could be down as much as 61.91%. Higher return, higher volatility. So just know what you're getting into before you do it. As for me, I'm okay with the volatility, so I've put my market cap minimum threshold at 50 million. All right, third takeaway is that the Magic Formula takes a certain amount of work and dedication. Even though it's a formula and it's supposed to make investing easy, it's not completely hands-off. Like, you definitely have to keep good records and remember to buy and sell the stocks on schedule and sort through the list each time. So definitely make sure you're up for that. It's not a ton of work. I only need to look at this about 4 times a year. and it is definitely easier than reading through 100-page annual reports and crunching numbers on financial statements, but you still need to keep a spreadsheet and check on the portfolio once in a while. And that is obviously more than you would do if you just invested in index funds or something super passive. That's generally how it works in the investing world. The higher the potential return, the more work you have to put in. But I think it'll end up being worth it. Last but not least, do the magic formula inside an IRA or some other tax-advantaged investing account if you can. There's already a lot to keep track of, and the last thing you want is to have to keep track of what taxes you're gonna owe on the gains and dividends. So I would really think twice about doing this in a taxable account, especially if you're a beginner, all right? So definitely try to do it in an IRA so that you don't have to worry about the tax impact of this strategy. So after 1 year of following the magic formula strategy, these are the 4 key takeaways that I wanted to pass on to you. And like anything worth doing, it's a long-term strategy, but it is gonna have a lot of ups and downs. But ups and downs are par for the course. You know, if the strategy made double-digit positive returns every single year and never lost money, then everyone would start buying magic formula stocks. They would drive the prices up, and then none of these stocks would be bargains anymore, and the formula would stop working. So by definition, the most profitable strategies are often the hardest to follow because they're contrarian. So I'm guessing most people won't have the patience to keep the faith and stick with this strategy long enough to work. But hey, that means there's an opportunity for you. As long as you're disciplined and you follow everything based on historical evidence, then you're bound to do really well with magic formula investing. So I would say if you're gonna start investing this way, definitely plan on sticking with it for the long run. Joel Greenblatt recommends a minimum of 3 to 5 years, but I'm thinking probably the longer the better. All right, so despite lackluster performance in the first year, I'm still a big believer in the magic formula, and I really think buying great companies at cheap prices is a good way to invest. So I'm in it for the long haul. Next year, I'll probably post a 2-year portfolio update, and who knows, maybe I'll be posting annual updates until I'm like 80 years old. Hopefully by then, the magic formula would have made me a multi-millionaire. That would be cool. We'll just have to see how it all turns out. Anyway, thanks so much guys for watching. That's it for my 1-year magic formula portfolio update. I hope you enjoyed this video. Don't forget to subscribe to my channel because I post new and awesome videos about personal finance and investing every Wednesday. I appreciate you. Do not go too crazy now that quarantines are getting lifted. So we still need to be careful. Take care of yourself and your loved ones, and I'll see you next week. Same time, same place. Bye.